this off. I am going to rely on everyone out there in virtual land to supply me with questions. Go ahead and throw them in the chat. I really want to hear some nightmarish stories. I want to hear some super stumping questions. One of the things that we're trying to do here today is also take an informal poll on how many buyer's agents have not been paid since the change in policy that went into effect on August 17. Has any buyer's agent not been paid? I hear silence. Okay, so it looks like overall we're doing pretty good on adjusting to the new way of life, which is pretty much a nothing burger, right? All right, great to hear it. But should we get stuck in a situation where we have a broke ass buyer, we have a seller who is impossible, and there's no way we can work it into the deal, we're also going to talk about situations where our lenders might be able to help us out. So without further ado, I'm going to turn this camera on to our illustrious panel, and they are going to do invites. Go ahead and pepper me with questions via text or chat. Please do.
This is Joni Espin. We call her the lending savant. She's one of our vendors, and she really truly is.
Justin, sorry, it's very hard to hear Angie. She's really quiet.
Okay.
Do you have a microphone?
I don't. Let me turn this around here and see what I can do. Give me a sound check, Angie.
How about that?
Terry?
That's better. Yeah, we can hear you a lot better.
Thanks.
Okay, I'm Angie Shaw with Fidelis. This is Joni Espin. She's one of our vendors, and she's also known as a lending savant because she's really brilliant when it comes to knowing really weird, odd scenario underwriting guidelines and being able to help us figure that out. This is Micah Davis. This is Jess Wren, the newest member of our Iron Valley lending team. And of course, this is Brent Stahl. So we are all here today. We would love to hear your questions.
Yeah.
We also want to hear if you've had any really weird lending situations or things that just make you scratch your head and think, that doesn't sound right to me, and kind of talk through that. That's going to help other agents who run up against these situations be able to, you know, have guidance and figure things out. So where's our moderator? Hila.
I'm right here. I was just.
You're on your own, sorry.
He just ran.
All right. So, do we have anything to kick off a?
I do just want to say, so in your email, they would have emailed you the PDF. This is a cheat sheet for inspections. We do get a lot of calls when you guys are writing contracts. Some people are still under the impression that FHA requires a water test if it's on a private well. That is not always the case. In general, it's not required. There are some situations where they're required, but this gives you an outline of what's required, what isn't, and what you need to put on the contract. So you'll have that in your email, and everybody here will get a copy of this.
Okay, excellent. Did you have anything particular that you wanted to start out with, or were you waiting for a nightmare scenario to discuss?
I love it. We're all here to just answer all the questions and listen to different scenarios, talk through them, be able to help. We do have lots of different ideas of how to help you roll your commission in or find you know, unique ways, which we kind of went over the last sales meeting, but we're happy to do it again.
Okay.
When we go back, I'd like to go over the scenarios of building commission in, or like what you've been able to do to help buyers agents get paid. Because have you seen it happening where they're not getting paid from sellers?
Yeah. Oh, yeah.
Reduce.
We have seen situations where they're not getting paid by the seller and they're having to pony up for the commission, but we reduce the down payment. We can look at that community, the 80-20 with no money down. We can look at FHA putting 3.5% down, rolling in some closing cost help. I know that's not ideal, but we are seeing more and more of it. Have you seen anything unique for that?
The same things. I mean, a lot of having to reduce the down payment and finance, more closing costs. And I think people, like when you say FHA, I think a lot of people are scared of FHA still because of all the inspections, but honestly, with the guidelines that came for conventional, like with health and safety, almost all the same things are reviewed by a conventional appraiser that would be reviewed by an FHA appraiser, honestly. So it's not that big of a difference of it won't qualify. I mean, if you're missing a GFI, a conventional appraiser is gonna call you out on that because it becomes a health and safety issue.
Now, we have seen, I always get calls from agents who are absolutely like floored when they do have a condition on a conventional loan, right? Like, this is conventional. How dare they? And do you want to talk a little bit about those safety concerns or kind of?
Sure. So,
Yeah,
yeah,
with Jane, when did this happen? Well, because we were talking, we haven't really seen much in convention.
okay, so he asked like, when did the change with conventional happen? So FHFA, without getting like super boring, FHFA is the federal home loan, like big, huge thing. And Fannie and Freddie are under conservatorship, which means the government runs them, which is the same as FHA, VA, and USDA. So Fannie and Freddie, the conventional, used to be private. And, back during the Obama administration, they went under conservatorship and they're still there. So FHFA tells them what to do. So they kind of all then said, this is a safety. If an appraiser sees a safety concern, they have to comment on it. Now, what I will say to you is sometimes appraisers go above and beyond. They might say something about scraping and painting, and on a conventional, that's not required, right? Unless there is a obvious sign of, there's mold growing behind that, you need to scrape and paint it, right? We're on an FHA, if it's a possibility of lead-based paint, we have to do that. So the biggest thing that came out though is probably 3 years ago, maybe 4. They started this thing called like SSRs, which is a submission summary report on a conventional loan. And basically what happens is it takes all the data from every appraiser appraisal that's ever been done in that area, takes every time your house has been used as a comp, every appraisal that's done on the comp we're using as comps, because think about every house that's a comp, if it had a mortgage, it had an appraisal on it, probably, right? There's sometimes and it puts all that data in to make sure it's all lining up, okay? So when all that happened, if an appraisal scores high, which the scale is 1 to 5, so if an appraisal scores below a 2.5, basically as a lender, we're just checking boxes. I mean, and I'll be like 100% honest, we had one the other day that was a 2, and the one room was like studs. And we're just checking boxes and moving on. But you, as the realtor, the homeowner, they have no idea what that house is going to score, right? So, but if it comes back as a 5, we have to deep dive that, which is the highest risk. We have to deep dive that because FHFA is going to deep dive that appraisal when it comes into them. And they're going to then ask questions because realistically speaking, FHFA finds reasons that we would have to buy loans back, and appraisals are a big part of it. So they're going to deep dive in and then ask questions about things. So when it first came out, there were more like put a handrail on the steps going down on a conventional loan. And that's kind of backed off because that's not in some areas it's a local ordinance, and others it's not. When this first came out, I saw people were asking for CO detectors on conventional loans, and that's not required either. It's not required on FHA, to be honest, either. So it's backed up, but anytime there's a change in the industry and those come down from FHFA to lenders, you're gonna see like an over push. Now, the other thing would be if you have a smaller lender that resells their loans on the secondary market. So for Fidelis, when you're doing a loan with them, they're working with an end investor that's gonna hold that loan. So when we make a decision on a loan, which we can make business decisions on loans, we're done with it, we're good. I mean, like one of the first loans we did with Micah, a local bank turned down an appraisal and we viewed it and said, we feel good about this, right? But if you're working with someone who is a reseller of loans, they're not gonna only underwrite to FHFA guidance, they're gonna also underwrite to the strictest of their investors' guidelines. So that's why it's very important when you are working with a buyer, or if you're working with a seller who has a buyer, that you're finding out who your lending partner is on the other side, because it matters. You know, it definitely matters. I see all the time where we're picking up a loan that someone else couldn't do and the appraisal was torn apart. And we're like, hey, we feel comfortable with that and have moved on. But of course, that costs time, money. It's a reputational risk if you're moving it, right? The seller gets frustrated. So it's just very important, you know, and that's why it's great that you have this lending team here working with you.
Was that property in Enola?
Yes, so I mean, kudos to Joni because she came alongside. So that was the deal with Tyler
Yeah.
Matisse earlier this year. So fell through 24 hours before closing. They were working with a local bank, but a large bank who they were just concerned about the appraisal, saying it did not seem to fit like the box that they wanted to for the market. They did a second appraisal, appraised at the same value. Values were great on both, and they just were not willing to take the chance. Now,
The property was over improved for the neighborhood, probably.
exactly,
Yeah.
exactly. Called Joni, and I mean, we literally returned that in 5 days, I think, got it back to the closing table. So, yeah.
And banks, like true banks, depository banks, sometimes have stricter guidelines on not only their appraisals, but their lending, because they're bound by a whole depository ratio that true mortgage companies aren't. So, you know, I know the lenders Fidelis does business with, and they're all true mortgage companies where we don't, none of us, and I'm speaking for the other lenders as well, have that caveat. And I came from a bank. I mean, I worked for Citizens Bank for 10 years, and we had stricter appraisal guidance than in a mortgage company.
Like Wells Fargo, when they used to do mortgages, like if a property even touched the flood zone, flood insurance was required. Even if all the buildings were well above it, if the property itself touched it. And I know that M&T, being based out of like Buffalo, New York, were super uptight about fuel oil tanks because they had a rash of them in their local market. So they were very touchy about that stuff. So as agents, we sometimes lose track that there are, biases and perspectives on, on almost every situation that,
When a lender gets hurt on something.
yeah.
You know, right, so that's just a hot spot for banks, and it's because they have a separate set of guidelines on how an appraisal has to be reviewed.
And so Fidelis doesn't have that other set of,
Fidelis doesn't sell any loans to banks, so Fidelis only sells loans to end mortgage companies. Yeah, to end mortgage companies. I was thinking about who all they do business with. They should only do business with us, but I was thinking about who all that they do business with, and they're all only mortgage companies that are just in the business of making and servicing mortgages, you know. So no, Fidelis doesn't, I mean, at some point they might do business with a bank, and banks also have other products that we may not have. So I'm not saying banks are bad. I'm just saying, as far as conventional appraisals being over scrutinized, that is very much an FDIC guideline, that's the other, government company that monitors, banks. So that's their guide.
We do have one bank, really sort of just strictly for our doctor program, physician program, that's 100% financing, no mortgage insurance. So, and
Which is a great bank program, yeah.
and that's their lane, and, they want that depository money because the projection of the physician's income is large and they want that. So they're willing to overlook a lot. For the physician loans specifically, they have a special calculation of how to calculate the student loan payments, because as you can imagine, a lot of the physicians come out of school with $400,000, $500,000, $600,000 in debt. And if you try to go through a regular loan, Fannie Mae, Freddie Mac, you're calculating that payment, they're not going to qualify. It doesn't matter what they're going to make. So there's a lot of concessions made. So that's the only bank that we deal with currently and sell through. But are there any questions online or weird situations that people have had?
No, not yet. Everybody wake up. One of the things that I deal with from the broker's chair a lot is when an appraisal comes in short. And the question, is, oh, I want to challenge this appraisal. How do I challenge the appraisal? Do you want to talk about what that process looks like from a loan officer's point of view?
No.
Trying to think the last time I challenged him.
I mean, he might not have had any cut appraisals,
I just had one.
okay.
Yeah, so I mean, first of all, I think, from our seat and where we sit, you are our client, your buyer is also our client, so we need to make sure that we're really bridging the gap well. So having a conversation with the agent first and foremost, uncover the hurdles that we're gonna be facing, and then I think working together as a team to really collaborate and make sure that we're collecting any additional comps that really fit that area within a certain mile radius, getting that submitted back to the appraiser for dispute. And I mean, that's the first step, really. Let's see where we can get them to climb to and then go from there. So I've had that recently. I had a pretty big cut recently. It was like 30,000, and we were able to get them to come up. Not all the way, but a decent chunk. So
And that's a victory right there, because appraisers generally don't do that. It's an opinion of value, and once they form their opinion, it kind of goes against their code of ethics to change their opinion because someone asks. So typically, to make a adjustment to an appraisal, you have to find some sort of unconsidered comp or a factual error that could enter into the computations and change the math on it. Now, what happens when it's a FHA appraisal that comes up short, or a FHA deal that gets cut?
I will say, just to piggyback on that, it's very important for the agents. We have the best shot. You send us the comps that you feel like that should be used, but it's also really important to send the verbiage back to us as to why you think those comps should be used, because it really does go a long way with the appraiser. If we just shoot out 3 comps, they're like, I left it on, whatever. Because to Justin's point, they gave a value. They, ego or not ego involved, I don't want to say, but
Code of ethics. It's
Oh,
it's
code of ethics.
the use path.
But as far as appraisal, the appraised value sticks with an FHA appraisal, so we gotta be super careful.
How long does that happen?
It sticks with them for 6 months,
Is that only FHA, or are there any other products that it sticks to?
just FHA.
Okay, so if something falls apart on FHA, you might have the potential to switch to another product if you had to. So you got a really mean appraiser who was from Reading, and the property was in, York, and they didn't know what they were doing, and the thing got blown up and he wouldn't touch it. You're stuck, that you can't use FHA again. You might have to go to a USDA or a conventional loan that kind of mimic the down payment to make that happen.
Yeah, I mean, we could potentially switch over to conventional 3% down.
Depending on credit scores.
But we probably would have qualified them at the 3% down conventional if they qualified, but you can still dispute an FHA appraisal. It's just, it goes a long way to provide data behind why you're sending additional comps. It really does help. I've seen it make a difference of them taking some extra time to look at it and really understand. We do not pick appraisers from out of the area. We have a local panel that are selected. We have to have a certain amount. And any agent out there who has a recommendation for appraisers in York, Lancaster, Cumberland County, Dauphin County, Perry County, please email me directly or email your Fidelis representative, because we desperately need appraisers on our panel. We don't go through a big national appraisal management company, because we can control the situation a little bit more, and we can vet the appraisers, so we're not getting some random person that's gonna give me a section in York that is maybe unique, and you really have to understand York to be able to appraise anywhere in the city
It's block by block, right?
on long level. Oh yeah, that's a good example. So you really need somebody who is from that area. In our area, like Camp Hill, Carlisle Borough, there's some like niche little areas, Mechanicsburg. It's literally street by street. So if you don't know that area, so that's why we're really, really firm about having our own panel. So if any agent on Zoom or here wants to submit an appraiser that they've had a great experience with, please let us know. You have 3? Oh, please send them to us. Yeah, we desperately need to, as the appraisers are aging out. It is an older, group of people in general. There's not a ton of new appraisers coming on board because of the education requirements, because of the apprentice requirements. So we'll take anything, just send them over if you've had a good experience.
And here's my standard plug for best operating procedure when it comes to a loan. If you are the buyer's agent or the listing agent, the best time to influence the opinion of that appraiser is before they make up the opinion. So make sure that you have your comps on the kitchen counter with your notes. This, subject property superior to this one, subject property inferior in this regard, but better in this one. Bigger garage, better kitchen. This one smelled funny. Whatever it takes, just make sure that that appraiser knows that you didn't just make a wild ass guess. That's an industry term. As to the value.
I have a question. So can you tell me from your perspective what your interaction is with an appraiser? Like, let's just say in the scenario that the loan does get cut, right? How do you interact with them?
So the process for the appraisal, the appraisal process from start to finish, when the borrower signs the initial disclosures, we send out the request for the appraisal to the appraisal management company. We do not know who that appraiser is until we receive the report. We are not allowed to contact anybody. So when we receive the report, if it's cut, then we can then reach out to the agents, receive the comps back, send the request to dispute through the appraisal management company, not directly to the appraiser. We're not really allowed to contact the appraiser directly.
And do you make any notes, or is it just like we're sending you the PDF of the MLS? That's what
we send, and that's why I'm asking for dialogue or verbiage with each comp that we're sending. If we've had that conversation over the phone, we'll create like a little PDF and say, hey, this is what they're looking for, this is why. But it's rare that we talk to the appraisers after the appraisal has been received.
I have a couple more questions on the appraisal thing, and then we're going to jump off to something else. But one is, if we do have an appraisal, what as market participants will call a bad appraisal, or something that we don't agree with, is it possible to request a different appraiser? Why not?
So there has to be cause to throw that appraisal out.
Deem it flawed.
Deem it flawed. Joni can speak to this because it can be considered fraud on a lender part. If we toss out an appraisal, it's really, really bad.
For the record, I have never seen it happen.
So you have to, like, the FHFA again controls the appraisal process, and you cannot cut an appraiser because they're not giving you value. And you can't say to an appraiser, I'm never gonna send you another loan if you don't lift this up. And you only have one shot to dispute the appraisal, like that's it. So if you forgot to add one comp, like that's it. So if you're going to deem an appraisal flawed, you have to go back to the appraiser and basically ask them to make these changes that are in error. So let's say that the square footage is incorrect, or they blatantly missed this comp, or you have information. We see more often than not, there's a sale that we're waiting our value on, and you have information that was a divorce sale, or it was a family transfer, and it's not accounted for as such. Or if it was a foreclosure, I mean, right now foreclosures have zero effect on the market, right? So if you have a one-off foreclosure, that should never be a comp. So you would have to be able to document that. Then the end lender has to document it, because for up to 10 years, we could be forced to buy a loan back if we flawed an appraisal and it was found out later that it's not accurate. So when I said earlier about the like SSRs that come back, so as lenders, when those come back, it kind of says to us, here's all the comps in this market, and here are comps the appraiser should have asked for. These comps were deemed differently. So we kind of have a blueprint on it already. Now, if it came in at a 2.5 and we feel like it's fine, we might just move on unless you're challenging it. So there's always a reason to challenge, but like Angie said, trying to deem an appraisal flawed is very difficult. You see it more often that an appraisal comes in and it feels like it's stretched value and a lender saying, why didn't you use this comp, and this comp? And appraiser says, I'm not adding those comps. And then we say, the appraiser's not communicating with us. We have to order a second appraisal. That's what happens more often than not.
Okay. What happens if we have a specialty kind of property that we want to make sure gets the right, a qualified appraiser? For instance, we sold an earth house recently. Sometimes we have country properties that are in the middle of nowhere and there's no appraiser who is really, who's bidding on this property, who's not from the city. Or maybe there's timber value involved. How do we take into account those kind of special wrinkles on a fully solar off-grid property or something that's heavily weighted on timber value?
Well, for the fully solar off the grid, no electric properties, you're self-funding those, right?
Yes,
As the broker?
that's correct.
Yeah, okay. I saw that memo.
I mean, so the word unique is horrible in lending, right? So this again would be when you want to meet the appraiser out there and provide a narrative and factual comps up front
In a
to
chill
support your
way.
value in a very nice
Don't
way.
take my comps.
Yeah,
Don't do
in
that.
a very nice way, yes. And if you have a previous appraisal on a property, even if it's old and you can't use those comps, it's always good to give it. So because listen, we all want an easy route to get work done. So if there's data that you have, provide it. It's not saying, hey, here's the value. It's like, hey, I know this property is a little unique. Look, an appraisal was done 4 years ago. Here's a copy of that appraisal, just in case it provides you any data, a sketch. An appraiser has to do a sketch on every property now. A sketch, it kind of gives you some detail on how they arrived at their value. And here's some comps that I used when I was listing the house or when we made our offer. If you need anything else, I'll let you know. That's really your best bet.
Appraisers want to know that you put thought into this and it wasn't using the
They don't
WAG
wanna-
method
They
and,
want to hear that's the price the seller wanted.
Yeah.
right.
So underwriters will also, and appraisers will also take into consideration with unique properties, exceptions to going outside the norm. Look, they're only gonna want comps within a couple block or a couple mile radius if we're in a really urban/suburban community. They understand. I did a farm down in, not a working farm, a farm down in southern York County, and it was 1 point something million. I mean, it was gorgeous, renovated. They had to go to a different county, and you can make exceptions for that. You just have to make your case. Look, the same buyers that I took around for this property that just bought this property, put a bid on it. I also took them to all these other ones in these other counties. And so it's going to be, could be an uphill battle, but exceptions are made for unique properties. Like
Yes.
that also.
Yeah, and I've had the same hurdles when it comes to super historic buildings where we had a townhouse in downtown Carlisle. It was attached. It was a 3,500 square foot townhouse built in 1860. They ended up pulling comps from Gettysburg and other places 40 minutes away, next county over, because they needed to go that far to find a comparable property. Okay, thanks for that. Do we have any access to lists of county programs or, a lot of these programs are county based, right?
System.
Yeah, do we have those?
Yeah, we can send that out to the team. We can send that out to the agents.
That would be super helpful. That was a request. Thanks,
So
MK.
York County and Lancaster County has tenfold. We're one of their approved lenders, and they give up to $10,000. And they there's some limitations on purchase price. I think it's 218, and then it's a bit higher for new construction. And then there's income guidelines, but it's a great program if you have someone that falls into that lane. There's some other ones, so we'll collectively put together all the down payment assistance programs and get it out to you by county.
Okay. Let's talk about self-employed borrowers.
All right.
I've got a bartender who claims 1% 5% of their tips. They basically make no money on their tax returns. Okay, maybe they're a truck driver then. All right, so like, how do we get this stuff through? Like, what do we do?
We do.
Mhm.
We have bank statement programs we can do, so we can, take a running total of their last 12 months deposits. That works well for truck drivers.
And bartenders.
And drug
and
dealers?
bartenders, Drug dealers, if you're a professional gambler,
Okay,
not that I'm recommending that, or if you have a, can I say it, OnlyFans?
Yeah.
OnlyFans account, just like, whatever. There's so many different things that. you
Social
could do.
media influencer.
social media influencer, very good.
If you trade on, Robinhood or things like that, that can get tricky. We have bank statement programs for primary residents. If you want to buy an investment property, it has taken us over a year to hone in on the absolute best no income verification, investment property loan programs. Like we're talking, I just priced one down in the lower sixes. That's
Oh, for
no
DSCR.
cash flow. And we can also do on projected short-term income. These guys are distracting me.
I see.
I lost my train of thought.
Micah?
Oh, sorry.
So we have a bank statement loan.
Okay, and we finally have a really amazing projected short-term rental investment property. But there are alternatives for primary residents because those programs are not available if it's going to be your primary residence. So Joni is amazing at making income work with, or trying to find, navigate the self-employed, or there's ways to only use 1 year, income. There's ways to use if someone has.
Can that be like 2 years ago, or does it have to be the most recent year?
Just recent.
Okay,
You can't use somebody else's tax.
Okay.
There's also ways to use if you have investment accounts, you can turn that into monthly income that we can use if you're at a certain age. There's caveats for that. There's some alternatives. We can get non-occupying co-borrowers. We just did a college student that he had $0 in income, none. He was a primary borrower and the parents co-signed. I know that's not always available, but that can be a resource.
as a non-occupying co-borrower,
He got 5% down.
0% income,
Zero.
all the income was on the non-occupying co-borrower. Is that's a conventional loan program?
Yes.
And all the assets can be the non-occupant co-borrower as well.
Is that like 14% interest, or where's that come in?
It would be 599 or 698.
Unbelievable. That's pretty cool.
Yeah,
Okay,
yeah, so. In that case, 5% down.
everybody reach out to all of your friends in college, try and sell them a house quick.
It's great. We look at that borrower, that, in this case, the college student, and say, okay, pretend he has income, what would he qualify as this borrower? And then the income just comes from the non-occupying co-borrower. It's crazy. It's wild. There's so many options. I know, self-employed is tricky, but we really do have a lot of different, avenues now to navigate.
I have a question. When someone co-signs, that means like they're 100% responsible for that loan. That's gonna show up on their
Yeah.
credit pool, on everything, and would affect their ability also, right?
Yes, and we do in cases like that, we always talk through like the plan for the future. The plan for this particular student, he was gonna graduate and get a job, and then a couple years down the road, refinance to get his parents' name off the loan. So there's always a long-term plan with that.
But if also the son paid the mortgage for 12 months and he can verify he paid it out of his own account, we would exclude that from the parent's debt ratio. So it would only affect them for a 12-month time frame. After that time frame, if you can prove the occupying borrower is paying the debt, you're not counting that debt service against the parents or whoever co-signed.
Okay,
Is Susan Anderson on?
yes.
Susan, I hope you heard that.
No comment. You can call her directly on that. That's super interesting loan program. information.
Well, just to piggyback on that, if you're meeting with, someone who's going through divorce, one of the spouses wants to stay in the property and you're in charge of finding the other spouse a home and you're worried about qualifying the spouse that needs to buy a home, we can use the last 12 months, payments, as long as it's not in a joint account. And so a lot of times they've been separated, they separate their money well before any of us get involved in the situation. So if that's the case, that's a way that we can exclude that mortgage payment. So just keep it in the back of your head when you're dealing with divorce.
That's great.
Yeah.
So what's the breaking point? What's the top line debt to income ratio that you've seen? Like that you and got a mortgage through?
VA,
I don't care.
FHA, it's different for everyone.
Well,
VA, I'm worried to even say it out loud.
like
So
54.
with VA, it stipulates that they want to make sure that you have residual income. That means how many dollars are left after you pay all your bills. That's what really drives VA and the debt to income. We've seen them run through at 67%.
Oh my God.
Listen, before you judge that we're making horrible lending decisions, sometimes the spouse has really bad credit. We know there's additional income. We know that they're moving. This is another situation. They're moving and the spouse is quitting their job and getting a new job at the new location. In our heads, we know there's going to be additional income.
Or for VA, for them to both be on the loan, they have to be married, right?
Correct.
So if they're not married, the household income might be much, much greater, but it's just the borrower who's allocating their income towards the housing costs.
Yeah.
It has the lowest foreclosure and delinquency rate because when you get a VA loan, you have to sign who your nearest living relative is. So if you miss your mortgage payment,
They call your
we're
mom.
gonna call your aunt and say, hey, Bobby didn't make his mortgage payment, what's going on? And if Bobby's getting any VA, any VA help or VA assistance, he's gonna make sure he's paying that mortgage payment. I mean, also, most people that go into the service have signed, a commitment and they have that level of extra integrity. So the foreclosure rate for VA is almost non-existent.
FHA is 56.2-ish, 56.4. Again, same situation. Conventional is a hard stop at 49.999.
So what's the highest of those categories? Which has the highest foreclosure rate? USDA, 100% down.
USDA is a stop at 43.
The USDA has the lowest debt to income ratio. It's skin in the game that makes a difference.
Yeah, and they're the
down payment.
most strict. The most strict.
Okay.
Yeah.
Touching on VA quick, there's been some changes in VA over the past year. Namely that the veteran is allowed to pay some of their own fees now. I think it equals the playing field. I'm not in favor of fleecing veterans, but it does let them compete toe to toe, where under the old guidelines, they might not have been able to. Those changes that went in a few years ago, I remember a time when the veteran couldn't even pay for the termite inspection. They still can't. So all right, the veteran cannot pay for the termite. Okay. I've heard different things from different folks and they're wrong, right? Okay.
What else can the veteran?
So the veteran can now, so the VA came out and said they can pay reasonable and customary real estate fees. So that's your commission, right? The buyer's agent commission. But still at this point, the marketing, like the buyer's marketing, fee that the real estate company may charge. At this point, the VA has not come out and said that the veteran can pay that. So that still needs to be seller paid or included in buyer's agency commission.
So the termite inspection, they're not allowed to pay for. What about a home inspection?
So the VA has a different rule about that. A home inspection they can pay for, but the VA only allows 1% of closing costs that a veteran can pay for. And out of that 1%, it's going to include underwriting fee, right? If you have an underwriting fee, tax service and MERS, right, which is a recording fee, and then the tax service to check the taxes, any processing fee, any verification of employment fee, work number, those have a fee. So all that incorporates into a 1% fee. So A home inspection isn't required for a loan, so if I was doing a VA loan, I would always tell a veteran to pay for that home inspection outside of the closing. Because it's not a loan requirement, it's a for buying requirement, but it's not a VA loan requirement, you understand?
I do. And while we're on VA, go ahead.
So if the termite falls under the 1%, we have been able to fund with the buyer paying that.
Not exactly.
Because they're saying that we can run it under the 1%. So we'll get back to you.
Yeah,
guys
we'll
on
get
that.
back to you on that.
Okay. It's just something that some sellers,
It may just be that it's something that's interpreted wrong or whatever, but I know so we'll get back to you on that, because it's always a little wonky with VA and some of these guidelines and what they fall under allowable and not allowable.
one of the most frustrating situations I had with VA at one point was a buyer was looking to buy a property. It was in Newville, a little bit of a larger lot. And they determined that too large of a proportion of the value was in the land and not the house. Do you want to talk about that? How's that?
So what is it, Joni? 50% if their value is more than 50%?
So it's not hardcore, like it used to be 35%.
Right.
Straight across the board.
That's what I got hit with.
Now it's common and customary for the market and what's the highest and best use. So, I mean, I've done homes that have 106 acres and you've had similar comps. Or I just had one in Chester County last week that had 35 acres and we had similar comps, but we had large barns and it was really set up to be a farm. I mean, they weren't farming it, but the highest and best use for that property was agricultural and not residential. So if you're trying to get a residential mortgage, that's really what they're looking for. And if you're in PA and you have like clean and green, or you have a conservatorship, that actually helps you because you can't farm that land then, you know, versus if you have a big riding ring and 6 barns and you go, oh, but I'm not going to use those.
Bottom line is VA is not in the business of financing
No.
farms. They're there to finance homes for veterans, right? So, but if you're in Newville, okay,
The veteran can pay as long as it's below the 1%.
the termite,
No, that's a hard and fast.
so now.
Yeah.
But that's commission, right?
We are.
Okay,
there
and I'll
are-
let them say, we don't allow it to be charged.
So that
They
is
do.
definitely a vendor by vendor thing. Some are allowing it, it's a hard no. So that is not a her thing. Some of them are taking flyers on this and just saying, you know what? We're gonna allow the veteran to pay the broker fee. So as long as it, falls under that 1%. So that's what we're dealing with right now. And our heads are like bebopping around like a ping pong because we don't know who's gonna accept what, and we have to be super careful because now there are a lot of agents who are not charging that, still not charging that to the veterans. So, but if you want to, and there's no judgment, you have to do what you have to do. Then we do have resources for that. But it is definitely a case by case basis, and you have to make sure with the vendor that it's gonna apply.
Thank you.
Yeah, we have again, like they can do whatever they want. We have a different channel where we work with brokers and we wouldn't allow it then, but on our lenders like Fidelis.
Because
don't
we
even-
lend our own money.
Yeah, we don't even check theirs because that would be if the VA came back, the VA would come back to them, not to us.
Oh,
So,
okay.
Yeah, I have to call Brian.
yeah.
Thank you for indulging me on the VA stuff.
Sorry about that, yeah. But the VA, I will tell you this, the VA is currently researching what is common and customary for every area. And that's going to be not just county by county, but like small, tiny MSA by MSA as well, to say what is a reasonable and customable buyer's agent fee and what is a reasonable and customable like marketing fee, because what they heard overwhelmingly from mortgage associations was if you don't make this change, you are stopping people from being able to compete for a home.
And
Okay.
That's obviously I know how Iron Valley feels about veterans, and we want them to have the best shot.
Yeah.
At
Sounds fun.
competing.
Yep.
And I will say,
Definitely
any VA, like a lot of your VA programs, like tunnels to towers and all those things actually will do carve outs where they pay not only the commission, but they'll pay the termite, the realtor fee, the home inspection, they'll pay all those closing costs for the veteran.
Because we came into a situation where agents were asking us like, well, can't the company pay that? And it's like, well, yeah, we love veterans, but we are veterans too. So we hate for two veterans or several veterans to pay more fees than anyway. What is the smallest mortgage you can loan on? What is the smallest amount of money you can loan?
So it's not, so we have to run it through a process that is called 9QM. So if it passes, and that's predatory fees, to make sure it doesn't go past a certain percentage. And we're obviously clearly not a predatory lender. We have aggressively low rates and things like that. But when you're talking about a $50,000 loan and you have an underwriting fee and a processing fee, well, that could be 4% of the loan amount. So then you add on any kind of other fee that has to be charged, just even like the broker fee, or that you're adding those up, it potentially won't pass that. So in general, I would say, what do you guys, what's the lowest you've ever done?
Don't go above like 60.
Yeah, that's what I was gonna say. So
60.
probably we're gonna fall around the $60,000-ish to make it past, what's called 9QM.
And then, there's pricing, right? There's additional fractions of a point charged on the smaller loan because, everybody need to make money on this process, right? So isn't it more expensive to borrow less potentially or borrow?
We charge the same price on any loan.
Okay.
So we don't, it's just your revenue is smaller because of the loan size, but we don't charge more for lower loan sizes. No.
Okay,
The QM.
because I'm pretty sure that's a thing.
The key
Well,
thing that you run into would be if they have a set lender fee, right, which incorporates, their cost of doing business. If you have a $500,000 loan, it's just much smaller percentage
Mhm.
of your points and fees than if you have a 60,000. So once you add in a lender fee and an appraisal fee, title, MERS, sometimes you've already failed QM
Mhm.
before the loan even can break even for the client, right?
Yeah.
So that's the problem sometimes, unfortunately, with smaller loan sizes.
What is the biggest red flag that you've stumbled across and still gotten the loan through?
Oh, and still gotten the loan through? I had a red flag that I didn't do the loan.
What's your,
I had a borrower apply and she, needed a cosigner, which is totally fine. And we are very accommodating. So we'll nights, weekends, Zoom, phone call. But we are going to at some point put our eyes on you or listen to your voice. And the borrower sent me all the supporting documents, the driver's license. I repeatedly asked for a phone conversation, would not happen. Zoom would not happen. Meet in person would not happen. And I said, I cannot proceed. No, she's fine. I said, I know, but unless I talk to her, I'm not doing this loan. Because I really felt like they were committing fraud with someone that did not have the capacity or know that their information was being used. So that was a huge red flag. Somebody think of a red flag that you had that was kind of wonky and then you actually got it through.
Closed one with an expired green card.
Oh, that is tricky.
Do they
Yeah.
have an EAD?
No, honestly, this was a long time ago and they just kind of went like that at the end of the deal. It was like,
Mike closed one with an expired license last week.
oh, yes, we did. But we went online and quickly.
We got a camera card.
Oh, yeah, I think I was there.
Yes,
The expired green card, I mean, you're going back.
yeah,
Like,
there's no,
There's no.
this was,
Well, some of them don't update, so if you had still the employment authorization document, you could have an expired one with that, depending on what kind it was,
And we can close loans with work visas, depending on what letter combination it is and how long they have it here for. So even if they're not a resident alien or have their green card, like Brent just said, and they have a work visa, we can potentially do something there.
Micah closed a loan for people that were missionaries out of the country, moving back, Yeah,
Yes,
they weren't even in the US.
That was tricky, yes.
They were US citizens.
I sold a house to somebody in Russia.
Did you really?
Yeah,
Did you really?
yeah.
During COVID?
No, it was before that, but she was in Russia and her dad had power of attorney, actually signed loan documents and everything, I think.
You know what, I do think of something that I think is worth bringing up right now, so, and I try to always keep this top of mind and share with agents, so. Always remember in the state of PA, we only recognize married and unmarried, separated is not a thing legally in the state of PA, so this can become a huge issue. Especially if you have borrowers that are applying through like our online portal, because there is the option, it has to be there in the residential mortgage application to select, separated. So I had this come in, Justin, I'm gonna share this, because this was actually our deal.
Let's do it.
Together, so, here we are 24 hours before closing, clear to close. This rears its ugly head with, title and the mortgage side. So I'm online scrambling, literally working with the borrowers to pay for their separation agreement and get it drafted online and get it submitted back through underwriting and
Yeah, whatever
review
it takes.
to get through closing, and we did it. But I mean, just always remember as you're answering that question, you're either married or you are not married. We can't have that separated box. So, and it can slip through the cracks. So just something to kind of keep top of mind.
We're getting divorced. You're,
We have one we'll do for it.
Perfect.
If you have someone going through a divorce, we'll do a simple signed agreement between the two of them, like we're not yet divorced. Whether or not our borrower, we don't care about the other person, but whether or not our client is paying any alimony or child support, and if the funds they're using are their own to use, and they can sign that and notarize it, and we'll take it, and if it's a dirty divorce, we'll take something from the attorney, just say, under Pennsylvania law, my borrower would not have to pay alimony, and we'll go from there.
so typically a divorce decree is what we're looking for.
Yes.
Or something along
Or a
those
legal
lines.
separation agreement.
Which is impossible to get.
Yeah.
what they have.
Yeah. All right. Are you aware of any, well, I'm reading a horror story here with lots of details from Lori, saying that they tried to challenge an appraisal and the lender said it would take at least 30 days to have that redone. Okay,
Should
They
be
have,
about
they
24
have,
hours.
with our AMC, they have 48 hours to respond.
right.
And just to note, VA, do you all know what Tidewater, evoking Tidewater? If you get in a VA appraisal, they will not actually tell you what the value is, but if there is a cut or a problem with the value, you'll get an email. We will get an email that they're enacting Tidewater, which is a VA clause that allows one shot for you to fight the appraisal. We have no idea what the appraisal comes in at. So
Before it's submitted, yeah, before it even.
they
comes
won't
in.
even submit it.
I think there should be a Tidewater on all mortgages or all appraisals, but
And so you have it, then we'll reach out to you and have that opportunity to, send in comps for the veteran and see what we can do.
Christian asked a great question, and I've seen this happen more frequently of late, where there's been a blessing from heaven, what I'll call a waived appraisal.
Yes, I'm
Right.
working on one.
So how do I influence my luck? How do I steer into that situation?
Large down payment.
Large down payment.
So, remember what I said earlier about the FHFA collecting all that data? So there's all the bad things I told you earlier, but the good things are, if you've ever had an appraisal on that property, or it's been used as a comp, it's in the system. And so you can hit the magic sauce, and I would tell you that if you're writing an offer, I mean, it's not as competitive today as it was 6 months ago, but if you're writing an offer and you know the address, if they're running findings for you, ask them to throw the property address in and see if you get a waiver, because they have 4 ways to get a waiver through Fannie and Freddie. And then there's another type of waiver called an ACE plus PDR, which is automated collateral evaluation property data report, which is basically anyone, not just an appraiser, but a real estate agent and inspector can go out to a home, measure it and say it still stands, take 6 photos, and there's no value given. So,
If we get that in the findings.
So what I'm hearing is there's a combination between the property itself and the qualifications of the borrower that come together to make this magic moment where the appraisal is just forgotten about. Except for we need to make sure it's still standing.
but only in that, so there's the true value waiver, which is like, you know, the magic sauce. It's like waking up on a Saturday morning and having no plans, your house is clean, have a coffee there, it's beautiful.
Your kids all get along.
Right, okay.
Love
It's
you.
funny.
So what's the bare minimum? Like, somebody's like, I'm putting 3% down, can I get a waiver? That's a no. So you might get it, you might get a waiver with as little as, all right. You're blowing my mind here. You might get a waiver with as little as 10% down. Okay, and this is not somebody who's got 60 or 49.9% debt.
Never gonna get a waiver on a VA loan or an FHA.
Okay,
They don't exist.
only Fannie Freddie. Only Fannie Freddie. So we're getting to the mix here.
The max DTI, I believe, that I've heard is a 48, that, I don't think that it goes above that, I don't think it hits the 49 mark for a waiver.
I was gonna, go
Sorry,
ahead.
go ahead, but
My
that's
friend
just
has some.
stuff we just said.
No, like on waivers recently, I found more like, well, you have to put the property address in when we run it, but it seemed to be more based on the actual offer price for the property, like the property was listed at like 485. And they wanted to offer like 565. It was not giving a waiver
Sure.
at 565, but then when I drop it to 500, I would get the waiver.
Okay. So,
Is that what you see?
And that's what he's saying too is also accurate. In that instance, if someone offered 565, it was listed at 485. If you put the sales price at 565, but the value at 485, if you're putting enough down, you might get a waiver there. We see that happen, especially when things were super competitive. We were seeing that happen more, like if someone had a large to put down, putting the value at maybe what the original listing was, if they bid above it, that's just the sales price, but they're already making up that difference.
and the reason is that the listing agent knew what they were doing and it was probably within the realm of reality, or the Zestimate confidence was very high in that price range. And the further you went above that, the lender Zillow flagged it for not properly, it's no good.
But it's also dependent upon your buyer as well. If the buyer says to Brent, I have $150,000, and then they meet with Brent and they have $5,000.
Right.
He
Then
could,
your waiver goes on.
he could
Okay.
lose the waiver,
Okay,
right? You
so-
see that too.
Yeah, and for this particular one, they had like 60% down. They had a ton of money down and didn't matter. I guess I don't know, does it pull comps?
So it's when there's other appraisals in that area, it kind of builds a data pool for that house, and there's a range of values that it would accept in that, basically. And you don't know what your secret sauce is gonna be, but they're doing that for just what Angie said. Appraisers are aging out at a faster rate than appraisers are coming in. So if you know any young people
We're gonna get
are
break from her.
middle-aged people who want a career change, being an appraiser.
is boring, but
Yeah.
I tried it. So
How do you really feel?
there is a, what we call an AVM, and what you have is a super sophisticated model where you're taking actual appraisal data, layering it up in a system. And if I'm selling a 200-year-old house on 30 acres in the middle of a county with 12 people in it, I'm probably not going to get a waiver. But if I'm selling a house that was built the same year as the other 200 houses in that housing development, and this is selling smack dab in the middle of what that average price might be, and my buyer is well qualified, I'm running into a higher probability that I'm going to get a waiver. But according to what I've heard from you, it's got to be a Fannie Freddie loan. It's got to be a max 48% DTI, or debt to income ratio, and a minimum of 10% down, to answer your question, Christian. Thank you.
What the difference is between a HUD, no, not HUD, a HUD and a HOA?
Nobody can.
the same, so the PUD is a planned unit development. So whereas a condo, you don't own the land underneath of you, the PUD, you own the land underneath of you. The homeowners association can be on a PUD or a condo.
It's a
Um,
managing body.
It's just a group that's formed. We have a community up in Harrisburg that is creating an HOA out of the thin air after 33 years of not having one, to cover the expense of a retaining pond in the community. So it's a body of people, board members, elected members, that collect the monthly fee, and a PUD is an HOA. It's the same, there's no
Yeah,
But
difference.
there are few PUDs. I mean, there's not a lot of PUDs.
Well, so most
So-
new construction homes in a neighborhood end up being a PUD, even if they don't have an HOA, right? A lot of them just end up being a PUD. And for lending purposes, it doesn't affect what they're doing if you're in a PUD, except if you have an HOA fee that you're paying, that's in your debt to income ratio.
Mhm.
But there's no extra approval or guidelines for a PUD. Now, when you go to a condo where you don't own the land and you're part, of the condominium, then that condominium has to be approved in order to get financing. But a PUD is just, and a PUD could be anything from an attached row home in York to a, $1.5 million house in a golf home community.
Single-family
Yeah,
house.
single family house in a golf home community. It could be that wide range, and the only thing that matters for is just the HOA fee.
So you have to have an HOA fee to be a PUD.
Not always.
We actually have had PUDs with no fees.
Yeah.
Yeah, because I feel like I've run up against that before,
Yeah.
and that's why.
And we have to prove it because they don't believe it, and surely there has to be a fee, but there isn't.
How do we as agent know if community is a PUD?
It's gonna be on the deed.
Yeah, there's a PUD rider for title, but we ask you as the agent if it has a fee. So,
Right?
yeah, I mean, if there's nothing listed, if there's no fee listed, we'll say, hey, have the agent confirm via email, there's no fee. And that's just debt to income ratio. We're not escrowing for that. We're not holding anything. It's just to make sure our client's qualified.
I'm going back through here to see if there's anything that I missed.
We have lots of PUDs in Lancaster without fees, don't we? I feel like there's a ton, like almost all the neighborhoods.
Yeah.
They don't have any because you don't have pools or
Mhm.
parks or anything. We
Yeah,
both
that's
live
a
in
good one.
Lancaster.
So you have a PUD without a fee.
Like I used to live in a neighborhood that was a PUD and we had no fee. There was a park in the middle of the neighborhood that the county maintained. That there was nothing, we had no amenities.
Can you have an HOA without a PUD? Okay,
Yeah, because there's gonna be a rider on your mortgage, PUD.
so you can have a homeowner's, all right. Got it.
There has to be a plan development for them to manage. So it would have to go that way. But it used to be years ago. Maybe 15 years ago, we would ask for PUD questionnaires, right? I mean, 15, 10, maybe less than that, maybe 8 years ago. Time flies when
And-
you're having fun.
And that PUD is for managing some sort of common element, like a stormwater.
It could be as simple as just the.
It could be stormwater stuff. It could be a sign out front. It could be a playground. It could be, I don't
A
know,
pool, of course,
tennis courts.
tennis courts, yeah, so.
And that could be where the PUD can look totally different. It could be you own only the land under your house, or you do have fee simple ownership of the whole 1.5 or 2.5 acres of your golf course community lot.
Well, in a townhouse PUD, you own the land directly underneath of you. That's it. Like, that's the difference between a condo and a townhouse. Well, I'll call it a townhouse, but the difference between a condo and a PUD, they can look just alike one another. They could be deep, attached row townhouses. A PUD, you own the land underneath of you. A condo, you own airspace. You're just from that up. So if you're in a PUD like that, you don't own the land. If you're in a single family residence PUD, you own your acreage. but you're bound by the rules of your HOA. Like, you can't put a shed there unless they tell you, or you can't paint your house blue unless it's, I mean, assuming that's the rules, yeah.
Okay.
Yeah, or have an RV parked outside, yeah.
Or clothesline. Okay. Anybody else have any other nightmares or burning questions to discuss? Thank you again for those of you who contributed. The rest of you, I love you too. All right.
See you at trunk or treat.
See you at trunk or treat. Oh, hey, while I have you, everybody in Rayak, we could really use your help at the Rayak meeting. That's next Tuesday, October 8th, 9 a.m., Wyndham Hotel, free breakfast, educational opportunity, and we need you to be there so that we can have a quorum so that we can vote and elect officers. And there's a change to bylaws, so
Did you talk to Sean?